markets going haywire and inflation haunting every dollar you earn, the old school advice is screaming one thing: buy gold. It's what you hear from your neighbor, from talking heads on TV, and it's a gut instinct that's been around for centuries. Gold is timeless. You can hold it in your hand, and it's supposedly the ultimate shield against financial chaos. We all have that image in our heads of shiny gold bars locked away in a vault, a symbol of real wealth in a world that feels anything but stable. And the hype is real, with Bank of America throwing out a target of $6,000 an ounce by spring 2026, and gold already soaring past the $5,000 mark. The temptation is stronger than ever. JP Morgan research forecasts prices to average over $5,000 in the last quarter of 2026, while Goldman Sachs has also boosted its year-end target to $5,400. The story is set. As governments print more money and debt piles up, gold is your best friend. But what if I told you that buying and hoarding physical gold is one of the biggest financial mistakes you could make right now? What if this so-called safe haven is actually a costly, unproductive asset that has a track record of failing you exactly when you need it most? The truth is, the smartest investors aren't just stacking bars of metal. They've found a better way. They're using a clever strategy to profit from gold's value without ever touching an ounce, a strategy that actually generates cash instead of just sitting there. In this video, I'm going to break down the 3 huge reasons you should not buy physical gold. We're looking at the data, not the drama. First, we'll uncover the hidden costs that secretly eat away at your returns. Second, we'll bust the myth that gold is a reliable inflation hedge. And third, we'll talk about the massive opportunity you miss by holding an asset that doesn't do anything. Then, most importantly, I'm going to show you exactly what the pros are buying instead, a powerful alternative that gives you all the upside of a rising gold price, but with one crucial difference: it actually pays you to own it. Section 1. Deconstructing the myth. Why we're obsessed with gold. Before we tear down the old advice, you have to understand why it's so powerful. Our love for gold isn't just a market trend, it's practically baked into our DNA. For thousands of years, across basically every civilization, gold has been the ultimate symbol of wealth and power. It doesn't rust, governments can't just print more of it, and it has a natural beauty that has fascinated people forever. This history gives it a psychological power that almost no other asset has. When you hold a gold coin, you're not just holding metal, it feels like you're holding a piece of history. This feeling of comfort is the first pillar of the gold myth. When things get crazy, we want something we can see and touch. The stock market is just numbers on a screen. Currencies are just pieces of paper. But gold is real. This tangibility creates a sense of security that a stock or a bond just can't match. It feels like the ultimate insurance policy. The second pillar is the safe haven story. It goes like this. When markets crash or inflation takes off, investors dump risky stuff like stocks and run to the safety of gold. This flight to safety drives up the price, protecting your wealth while everything else is burning down. This idea is so common that it can become a self-fulfilling prophecy, at least for a little while. The news screams about uncertainty. People get scared, they buy gold, the price goes up, and the story gets reinforced. The third pillar, and maybe the most powerful one today, is the inflation hedge argument. The logic feels solid. Governments can print endless money, which kills the value of your currency and your savings, but gold is finite. You can't just make more. So as the dollar or the euro loses value, the price of gold in those currencies has to go up. It's sold as the ultimate way to protect your savings from being eaten by inflation. And to be fair, during a few periods of crazy monetary policy, like the 1970s, gold did perform incredibly well, which cemented its reputation. So you have these 3 forces working together: the psychological comfort of something real, the story of a safe haven, and the ironclad logic of an inflation hedge. It's a story that's easy to believe, especially when fear is running the show. It's why so many smart people still think stashing away shiny metal is the key to financial safety. But as we're about to see, when you look past the story and at the cold, hard numbers, those pillars start to look pretty shaky. Section 2. The Takedown Part 1. Gold is not an investment. It's an expense. Here's the biggest lie ever told about gold, that it's an investment. Let's be clear. An investment is something you buy because you expect it to make you more money. It's a productive asset. A stock is a piece of a company that sells things and tries to make a profit. A bond is a loan that pays you interest. A rental property collects rent. These assets work for you. Now, what does a bar of gold do? Absolutely nothing. It just sits there. It doesn't make anything, it doesn't generate income, and it doesn't pay you a dime. The only way you make money from physical gold is if, someday, someone is willing to pay you more for it than you paid. Your entire profit depends on price going up. Gold is more like an insurance policy than an investment. But here's the kicker. Unlike insurance, where you just pay a premium, holding gold comes with a slow, constant bleed of hidden costs that actively work against you. Let's talk about these costs. First, you pay a premium just to buy it. When you buy a gold coin or bar, you don't pay the spot price you see on the news. You pay a premium over that, anywhere from 1 to 10% or even more. That covers making the coin, the dealer's cut, and shipping. This means your investment is already down the second you buy it. If gold is $5,000 an ounce, you might pay $5,200 to get it. Gold has to go up 4% just for you to break even. But it doesn't stop there. Now you have to store it. Keep it at home? Even in a great safe, you risk theft and your home insurance probably won't cover its full value without an expensive add-on. The smarter option is professional storage in a bank or a private vault. That's not free. Storage fees can run you hundreds or thousands of dollars a year. You pay that every single year whether gold goes up, down, or sideways. Then, when it's time to sell, you get hit again. Just like you paid a premium to buy, you'll sell at a discount to the spot price. Dealers need to make a profit, so they buy it back for less. The spread is another hurdle you have to clear before you see a single dollar of profit. Finally, there's the taxman. In the U.S., the IRS classifies physical gold as a collectible. This means if you sell it for a profit after a year, you don't get the nice long-term capital gains tax rate you get on stocks. Nope, you get hit with the collectibles tax rate, which can be as high as 28%. That's a much bigger bite out of your returns compared to real investments. So let's add it up. You pay extra to buy, you pay fees every year to hold it, you lose a chunk when you sell, and if you somehow make money after all that, the government takes a bigger piece. This is why I say physical gold isn't an investment, it's an expensive hobby. It's like owning a pet rock that you have to pay to feed and house. While you're paying for the privilege of owning it, your money is just sitting there, doing nothing. That's opportunity cost, the silent killer of wealth. Okay, so gold is expensive to own, but the diehards will say those costs are worth it for one huge benefit: protection from inflation. This is the main event in the pro-gold argument. But does it actually hold up? When you look at the data, the link between gold and inflation is, to put it nicely, really inconsistent. Gold's entire reputation as an inflation hedge was practically built in one decade, the 1970s. During that period of insane stagflation, gold went to the moon while the consumer price index skyrocketed. That one amazing decade created a legend. But investing based on one cherry-picked decade is like predicting a musician's entire career based on their one-hit song. It's a bad move. Let's see what happened next. If gold was a reliable inflation hedge, it should have kept rocking through the 1980s, a decade that still had plenty of inflation. Instead, the exact opposite happened. The price of gold got crushed. People who bought gold at its peak in 1980, thinking it would protect them, had to wait almost 30 years just to get their money back in dollar terms, and even longer when you account for inflation. This isn't a one-off thing, it's the norm. The data shows there's a very weak connection between gold's price and inflation over any normal investing timeline. Sometimes gold rises with inflation, sometimes it doesn't. You wouldn't use a smoke detector that only worked half the time, so why would you bet your savings on an inflation hedge with such a spotty record? So what really drives the price of gold? It's far more sensitive to real interest rates and the strength of the US dollar. Think about it. Gold pays you zero interest. When real interest rates, that's the interest rate minus inflation, are low or negative, holding a zero-yield asset like gold doesn't cost you much in missed opportunities. That's when gold looks good. But when central banks hike interest rates to fight inflation, holding gold becomes a terrible deal. Why hold a lump of metal that costs you money when you can get a safe, positive return from a boring old government bond? This is what crushed gold in the 1980s. It wasn't that inflation vanished, it was that the Fed jacked up interest rates, making bonds way more attractive. The bottom line is this: relying on gold to protect you from inflation is a gamble. Sure, it might hold its value over centuries, but for any time frame you actually care about, its performance is a coin toss. There are much better and more direct ways to hedge against inflation. Chaining your financial future to an asset as unreliable as gold isn't a strategy, it's just wishful thinking. All right, we've just busted 2 of the biggest myths about physical gold. If this is making you rethink your strategy, do me a quick favor and hit that subscribe button. We drop videos like this every week to cut through the hype and give you the data-driven truth you need to build real wealth. Don't miss the next one. Now let's get to the most important part. If not gold, then what? So the case against physical gold is pretty clear. It's expensive, it's unproductive, and it's an unreliable hedge. The natural next question is, what about the other ways to get in on gold? The 2 most common workarounds are gold ETFs and gold mining stocks. And while they solve some problems, they create new ones and ultimately fail the most important test. They don't generate reliable income. First up, gold ETFs, like the popular GLD. On the surface, they look perfect. They track the price of gold, they're super easy to buy and sell, and you don't have to worry about storing a bunch of metal bars. They solve the logistical headache. But they don't solve the fundamental problem. Gold ETFs, just like physical gold, produce zero yield. You're still just betting on the price. And while you aren't paying for storage directly, you're paying a management fee every single year, called an expense ratio. For an ETF like GLD, that's around 0.40%. That might not sound like a lot, but it's a constant drag on your returns, year after year, just like storage fees. It's also worth remembering that with most gold ETFs, you don't actually own the gold, you own shares in a trust that owns the gold. For most people, that's fine, but it does break that tangible appeal that got them interested in the first place. So with an ETF, you get the same zero-yield product in a slightly more convenient wrapper. This leads people to the next idea: gold mining stocks. The theory here is awesome. A mining company should give you leverage on the gold price. If gold goes up, the miner's profits should go up even more, sending the stock to the moon. Plus, a mining company is a real business that can pay dividends. It sounds like the best of both worlds. But the reality of investing in gold miners is just brutal. Yes, they have leverage on the way up, but they have crushing leverage on the way down. Mining is an insanely difficult, expensive, and risky business. They face a ton of risks that have nothing to do with the price of gold. Geological risk, what if the gold isn't there? Operational risk, cost overruns, broken equipment, and political risk. A foreign government could just change the rules or take over the mine. Because of all this, the sad truth is that, as a group, gold mining stocks have been a terrible long-term investment. They have consistently and dramatically underperformed the very metal they're digging out of the ground. There are short periods where they do great, but over the full cycle, they are more likely to destroy your money than create it. Picking a winning mining stock is less about being right on gold and more about being a world-class expert on geology, engineering, and geopolitics. It's a game most people lose. So we're stuck. Physical gold is a dead rock, ETFs are just a paper version of that dead rock, and miners are often terrible businesses that can't even keep up with the metal itself. All of them fail the most important test of a real investment, the ability to generate a steady stream of cash flow. But what if there was a way to get the best of all worlds? Exposure to gold, protection from all that risk, and a consistent growing dividend. There is. And it's the secret the smart money has been using for decades. Section 5. The buy this instead. Gold royalty and streaming companies. Okay, we've torn down the case for gold and its flawed alternatives. Now it's time to reveal what you should be buying instead. The answer is in one of the most brilliant business models you'll ever find: gold royalty and streaming companies. Imagine you could own a piece of dozens of the best gold mines in the world. Imagine you got paid on every single ounce of gold they produced, but you didn't have to spend a dime digging the hole, running the trucks, or managing the workers. That's what a gold royalty company does. They are the financiers, the smart money of the entire mining industry. Here's how it works. A royalty company gives a mining company cash up front, money the miner desperately needs to build the mine. In return, the royalty company gets the right to a percentage of the mine's revenue for its entire life. For example, a company like Franco-Nevada might give a miner $100 million for a 2% royalty. That means for every single ounce of gold that mine ever produces, Franco-Nevada gets 2% of the sales price forever. It doesn't matter if the miner's costs go up. The royalty gets paid right off the top. The other model is streaming. It's similar, but instead of a percentage of revenue, the company gets to buy a percentage of the mine's gold at a super low fixed price. For example, a company like Wheaton Precious Metals might provide cash in exchange for the right to buy 10% of a mine's gold at, say, $400 an ounce. If the market price of gold is $5,000, Wheaton buys it for $400 and immediately sells it for a $4,600 profit on every single ounce. Their profit margin automatically gets wider as the price of gold rises. The genius of this business model is what it avoids. Royalty companies are immune to the risks that kill mining stocks. They have no operational risk. If a miner's fuel costs spike, it doesn't affect their royalty. They have no capital risk. They don't have to keep pouring money into the mine. They make one investment and then they just collect the checks. This creates an incredible business with huge profit margins and predictable cash flow. Now, let's compare this to physical gold. A bar of gold pays you nothing. A gold royalty company collects cash from dozens or even hundreds of mines and pays a big chunk of it to shareholders as dividends. While your gold is just sitting there, royalty stocks are paying you to own them. The data is clear. Over the long run, gold royalty companies have consistently and massively outperformed both physical gold and gold mining stocks. The model also has something called free optionality. Royalty companies often make deals on land that's still being explored. They might pay a little for a royalty on a promising property. If the mining company later finds a giant deposit there, the value of that royalty can explode, 100x, even 1000x, at no extra cost to the royalty company. This gives them massive, uncapped upside. One company, Gold Royalty, GROY, has a strategy of generating these early-stage royalties, which offers the potential for huge returns as projects are developed. This is why the core idea is so simple and powerful. Gold preserves value. Royalties multiply it. Holding physical gold is like owning a single insurance policy. Owning a portfolio of gold royalties is like owning the entire insurance company. It's the difference between being a spectator and owning the toll booth on the gold superhighway. So let's bring it all home. For years, you've been told a simple story. When you're scared, buy gold. Today, we've seen that this story is dangerously flawed. Physical gold isn't a real investment. It's a dead asset that costs you money to own and generates zero income. We've also seen its reputation as an inflation hedge is mostly a myth. Its performance is all over the place. The common alternatives like ETFs and mining stocks either have the same flaws or introduce even bigger risks. The fundamental mistake is confusing insurance with an investment. Gold is financial insurance, but you don't build wealth by hoarding insurance policies. You build it by owning productive assets that generate cash flow. The system rewards flow, not storage. This is why the answer isn't to give up on gold entirely, but to invest in it the smart way. By shifting from the metal itself to the companies that finance the industry, you change the entire game. Gold royalty companies give you the upside from a rising gold price while protecting you from the nasty risks that plague the miners. Most importantly, they turn a dead, zero-yield asset into a living, breathing source of cash and dividends. They don't just preserve value, they are built to multiply it. So, the next time you hear someone say you need to buy gold as a safe haven, I want you to remember this. Stop thinking about owning the rock. Start thinking about owning the business model that profits from it. Ditch the dead metal in the vault and start building a portfolio of cash-flowing gold assets that actually work for you. That is how you truly protect and, more importantly, grow your wealth in the years ahead.